Welcome to this explainer. Look, the 30-year Treasury yield just hit its highest level since 2007. Now, you might hear about Treasury yields and think, okay, that's just technical jargon for the Wall Street crowd. But the reality is, hidden inside that yield number is the actual price of money. It dictates the borrowing cost for literally trillions of dollars of debt. And right now it is flashing a massive warning signal that we haven't seen in nearly 2 decades. The headline numbers we see every day, they're just the tip of the iceberg. The real story here is the damage quietly rippling underneath the surface.
And that hidden problem revolves around a truly staggering number, $2.5 trillion. This represents a shadowy credit asset class where some seriously dangerous cracks are beginning to surface under the radar. We're talking about a space where interest rates are rising at the fastest pace in recent history, and signs of credit stress are absolutely materializing in the data. Yet somehow, many players in this industry are still out there selling the idea that everything is completely under control. They'll tell you the market is healthy, the warnings are overblown, but the reality is those two things simply cannot coexist. And the hush-hush nature surrounding this massive discrepancy is largely by design. So with global sovereign bond markets acting like meme coins right now, we really have to ask, why did the typically boring bond market just quietly pull the plug on the party? I mean, think about it. Recently, 4 of the largest sovereign bond markets in the entire world, including the UK, Germany, and Japan, started doing their best impression of Dogecoin after an Elon Musk tweet. We saw yields spiking to multi-decade or even all-time highs. The bond market is supposed to be the adult in the room, right? Predictable, uneventful, the thing your grandpa falls asleep watching. But while everyone else is completely distracted watching stocks go vertical on AI hype, the bond market is quietly sounding a massive alarm.
Which brings us to Section 1, the price of money, and unpacking the bond market mechanics.
Okay, to really get why there's a panic, we just need a quick refresher on how bonds actually work. At their core, bonds are essentially just IOUs. Whether it's the government, a big company, or whoever wanting to borrow money, they issue a piece of paper promising to pay back a fixed amount at a specific date. Buyers bid for that paper, and the price they are willing to pay dictates everything else. The absolute crucial point to understand here is this inverse relationship. When buyers pull back, the price drops and the yield goes up. It works exactly like a seesaw. If everyone is scrambling to buy a bond, the price gets bid up and the yield falls. But if buyers aren't interested, well, the price has to drop to attract new money and the yield rises. Price down, yield up. It's that simple, but that mechanic is the key to decoding this whole situation.
Right now, we've got a perfect storm of 4 distinct forces combining to drive those yields higher across the board. First up, the Fed hiked the baseline interest rate, so nobody wants to buy an old bond paying a lower yield unless it's heavily discounted. Second, inflation means your future dollars are worth less, so naturally you demand a higher return up front. Third, the U.S. government is issuing, well, Costco-sized amounts of new debt, and the auction room is just running out of eager hands. And finally, those traditionally reliable foreign buyers, they're pulling back their demand. This perfect storm forces bond prices down and yields way up.
Let's move to Section 2, following the floating rate, and the danger at the short end of the curve.
While long-term rates price in decades of fiscal decisions, the short end of the curve is where the Federal Reserve's fingerprints are causing immediate, painful impact today. The Fed has dramatically hiked short-term rates, which basically passes today's inflation problems directly onto the shoulders of borrowers. To grasp this, we have to contrast predictable fixed-rate debt with floating-rate debt. Most of us understand fixed-rate debt, like a traditional mortgage. You lock in a rate on day one, and no matter what the economy does, your monthly payment stays exactly the same. But floating-rate debt is a whole different beast. It ties your interest rate directly to a public benchmark. If that benchmark goes up, the borrower owes more money immediately.
And what is that benchmark? It's SOFR, the Secured Overnight Financing Rate. It's basically the overnight receipt for the entire U.S. financial system. It's not a guess, it is a hard number published every single morning based on actual overnight borrowing trades. Back in early 2022, SOFR was essentially sitting at 0. But then the Fed started aggressively hiking, pushing it from 0 all the way to over 5%. So any company out there holding a floating rate loan suddenly saw their interest payments absolutely skyrocket overnight.
Which leads us perfectly into Section 3, the private credit trap. This is what happens when floating rates go very wrong.
To see where the impact of that 5% spike actually lands, we have to follow the money downstream into private credit. We're talking about loans from middle market companies, businesses too big for your local bank but too small for Wall Street. These loans rarely trade publicly. And the kicker is that the vast majority of them are overwhelmingly floating rate. Let's look at a software company called Pluralsight, because their story brilliantly illustrates the real-world devastation here. Back in 2021, they were acquired and saddled with over $1 billion of floating rate private credit debt. When software was near zero, the math worked out perfectly. But as soon as that rate spiked over 5%, Pluralsight was completely drowning. By August 2024, the interest payments just became unsustainable. Lenders had to step in, inject new capital, and essentially take 85% ownership of the company. They were wiped out.
And this brings to mind a great quote from JP Morgan CEO Jamie Dimon during an earnings call about cracks in the credit market. He said, "When you see one cockroach, there are probably more." It's a slightly humorous quote, but it's honestly terrifying because it sets up the reality perfectly. Pluralsight wasn't unique. They were just one highly visible borrower and a massive stack of companies dealing with the exact same issue.
Because nearly all of these middle market companies absorbed the exact same compounding rate shock off SOFR, the data is now flashing bright red. The private credit market has exploded, growing almost tenfold since 2007. And now, Fitch data, which tracks more than 500 of these middle market borrowers, reveals the private credit default rate just hit 6%. Let that sink in. That is the highest default rate recorded since they started tracking this space.
So let's jump to Section 4, Sneaky Accounting, and how they are hiding the damage with PICs.
You're probably wondering, if defaults are hitting record highs, how on earth is the industry pretending everything is totally fine? Well, they use something called a payment in kind feature, or a PIC. Normally, if a borrower can't pay their cash interest, it triggers a default, right? It forces a restructuring and a slow walk to bankruptcy court. But a PIC politely allows a struggling borrower to just skip the cash payment entirely. Instead, the unpaid interest gets tacked onto the principal debt balance owed at maturity. Technically, because no payment was missed, the loan amazingly still counts as performing. No cash was received, but hey, no default either.
Let's walk through the total absurdity of this loop step by step. Step 1, a struggling company can't afford that higher cash interest payment. Step 2, that unpaid interest is capitalized, meaning it's just added straight into the loan's principal balance. Step 3, the private credit fund then reports that uncollected unpaid interest as actual income. And step 4, this is the crazy part. Because these funds often operate as business development companies with strict tax rules, they are legally required to pay out a real cash dividend based entirely on that fake, paper income they never actually collected.
And the data proves this sneaky accounting is spreading fast. It's functioning like duct tape slapped onto sinking companies to hide the distress from investors. Right now, around 11 to 12% of private credit loans include these PIC features. And get this, over half of those are bad PICs, meaning they weren't part of the original deal, they were desperately added on later because the borrower started struggling. In fact, 60% of recent monthly defaults involve loans transitioning to this exact payment-in-kind structure. For some of these funds, a staggering 14.5% of their total reported income is literally just unpaid interest.
All right, final layer, Section 5, the maturity wall and the inevitable collision.
We are now dealing with incredibly opaque loans classified as Level 3 assets. Because these private credit loans don't trade publicly, accountants label them Level 3, which is the most illiquid and subjective category in financial reporting. There's no active market data, so the funds rely entirely on their own internal, subjective models to tell you what the assets are worth. But despite all the accounting tricks we just covered, MSCI found that those internal models are quietly slashing values. Over 10% of private credit loans are already marked down internally by at least 50 cents on the dollar. The distress is very real, and it's heavily concentrated right below the surface.
And that brings us to this massive number, $85 billion. That represents the looming maturity wall of BDC loans coming due between 2026 and 2029. This is the tidal wave quietly building in the background. Look, you can use payment-in-kind features to kick the can down the road for a few years, but eventually the loan matures. When that $85 billion comes due, all of that debt, much of which was originated when interest rates were practically zero, must inevitably be refinanced at today's punishing high interest rates.
So, what does this all mean? Who actually faces the consequences when the math finally catches up? You can hide a loss on a balance sheet with creative accounting, and you can roll unpaid interest into a bigger principal to call a distressed borrower a performing loan. But bad math doesn't just disappear. The math is still the math. When this wall hits, someone has to take the loss. The real question you should be asking yourself is, when this $85 billion wave finally crashes, will your portfolio be standing in the blast zone? Keep a very close eye on this space because this story is truly just getting started. Thanks for joining me on this explainer, and keep learning.